The quarter, as you know, was shaped by an uncertain global environment characterized by geopolitical tensions, volatile commodity and currency markets. Against this backdrop, India as an economy demonstrated notable resilience. The economy benefited from solid foundations built over a period of time. During the quarter specifically, coordinated fiscal and monetary policy actions helped to manage energy security, inflation, and currency volatility that we know. In all this context, what we saw was that the FMCG demand environment remained stable, reflecting the underlying strength of consumption as well. In this entire context, as you saw results, we delivered a turnover of 17,184 crores with an underlying sales growth of 10%, driven equally by volume and price. This marks our highest growth in 13 years. We progressively stepped up performance from 3% in first half of FY26 to 10% in this quarter while strengthening our competitiveness. What's more heartening is that our bottom line has also grown double digit, and I'll spend some time on this later on. We delivered this performance in a volatile environment through competitive modes built over time. First, our global supply chain network, R&D agility and manufacturing capability ensured continuity of supplies and faster response to market demand. This helped us to maintain service levels during this period of supply crisis as well. Second, our resilient portfolio straddling across price-benefit pyramid and strength of our brands enabled us to implement calibrated pricing actions while preserving the consumer franchise. Third, despite the cost pressures, we continued to invest behind brands by stepping up absolute A&P spends to the highest level in the last 11 quarters. We further strengthened our omni-channel presence by growing distribution in general trade and continuing offline expansion of digital-first brands such as Minimalist and Simple. And finally, our financial agility enabled us to balance near-term pressures with long-term value creations. That brings me to the overall consolidated results. Our EBITDA margin at 23% was within the guided range. Our absolute EBITDA grew 8% year-on-year, while profit after tax before exceptional item grew 9% year-on-year. The reported profit after tax declined 2% on account of one-off tax credit in JQ25. The tax credit was to the extent of 337 crores. If you adjust for that, then the year-on-year reported underlying PAT has grown by 11%, which is same as profit before tax as well. This performance reflects the quality of our earnings, which means double-digit top line and double-digit bottom line growth and resilience of our business model. Moving to segment performance for the quarter, Home Care delivered 14% USG, driven by high single-digit UVG. This marks our strongest performance in 3 years. Both Fabric Wash and Household Care delivered double-digit volume-led growth. Within this, Liquids continued its double-digit growth trajectory. We continue to see inflation in crude-linked derivatives and are taking calibrated price increases across the segment. Beauty and Wellbeing delivered 12% USG, driven by high single-digit UVG. Within this, Hair Care delivered another quarter of double-digit volume-led growth, driven by premium hair care. We further strengthened our market leadership during the quarter. Skin Care and Color Cosmetics business grew in high single-digit, led by double-digit growth in premium skin care. Within this, Minimalist recorded double-digit growth and continued to expand aggressively in offline channels. Oziva saw a near-term softness. We continue to invest behind the portfolio and are confident of its long-term growth potential. Coming to Personal Care, the business delivered 4% USG driven by pricing as this segment continued to see palm oil inflation for the second consecutive year. Skin cleansing grew mid-single digit. Premium bars and body wash within that continued its double-digit growth trajectory led by volumes, which is outlining our premiumization strategy in personal care. Oral care delivered mid-single digit growth. with premium innovations like Close-Up White Now continuing to gain traction. Foods delivered USG of 7%, which is again a step up of growth sequentially, driven by mid-single digit UVG. Premium tea within this reported low single digit UVG, while coffee delivered double-digit volume-led growth. Lifestyle nutrition, which is Horlicks and Boost, delivered double-digit growth in this quarter. This is its fifth consecutive quarter of positive UVG and a strong growth. During the quarter, Boost crossed the 1,000 crore annual turnover milestone, making it our 21st brand to be in the 1,000 crore club. Packaged foods delivered high single-digit growth. We expanded Kisan chutneys with 2 new variants during the quarter and continues to see step up as we move forward. As we continue to deliver the short-term performance and step up, we are investing ahead of the curve to build capabilities and remain future fit in marketplace. A powerful example of this commitment is the launch of Unilever Fragrance House in India. It brings together the science of fragrance creation with consumer insight and artificial intelligence closer to one of the world's fastest growing markets. Our liquid labs of the future in Mumbai is another such example. The lab can accelerate formulation development timelines by up to 6 times to respond with speed to consumer needs. In supply chain, our Haridwar and Sonipat factories were recognized by World Economic Forum's Global Lighthouse Network for supply chain resilience and sustainability categories respectively. HUL now holds 8 WEF Lighthouse designations across 6 sites, the highest for any company in India. And finally, we are embedding AI across our value chain. An example of this is our first digital distribution center in Vijayawada, where AI-embedded real-time visibility creates a digitally orchestrated fulfillment ecosystem to serve consumers better. Taken together, these investments are building the foundations for long-term value creations along with many others. Now coming to our midterm outlook. The economy continues to be resilient and we expect the consumer demand, FMCG demand, to remain stable. Having said that, we continue to monitor the progress of monsoon and evolving geopolitical developments. Backed by the actions that we have taken, we remain confident that fiscal year 27 will be better than fiscal year 26, which has been our guidance so far. And we expect the consolidated EBITDA margin to be around the current guided range, which has been our medium-term guidance. Our focus remains clear and unchanged. Drive competitive, volume-led growth anchored to our key strategic priorities. With this, I conclude our prepared remarks and will now take questions.